Environmental, social, and governance (ESG) investing has evolved from a niche investment practice into a major component of global capital markets. ESG investing refers to the incorporation of environmental, social, and governance factors into investment analysis, decision-making, and ownership practices with the objective of improving long-term risk-adjusted returns while supporting sustainable economic development. The growth of ESG investing has been driven by increasing investor awareness, regulatory developments, improved ESG data availability, and recognition that sustainability factors can materially affect financial performance. Today, ESG investing influences portfolio construction, asset allocation, risk management, and stewardship activities across a broad range of investors, markets, and asset classes worldwide. From a geographic perspective, ESG investing has achieved significant global penetration, although adoption rates vary by region. Europe has historically been a leader in sustainable investing due to strong regulatory frameworks, public policy support, and institutional investor participation. North America, particularly the United States and Canada, has also experienced substantial growth in ESG assets under management. Asia-Pacific markets, including Japan and Australia, have increasingly embraced responsible investment practices as regulatory initiatives and investor demand expand. According to global sustainable investment statistics, responsible investment represents a significant proportion of professionally managed assets across major regions, demonstrating that ESG investing has become a mainstream global investment approach rather than a localized trend. The scope of ESG investing can also be evaluated according to investment strategies. ESG integration is currently the largest sustainable investment strategy globally, involving the systematic inclusion of ESG factors within traditional investment analysis and decision-making processes. Other widely used approaches include exclusionary or negative screening, norms-based screening, positive screening, best-in-class investing, thematic investing, impact investing, and shareholder engagement. Different regions often emphasize different strategies. For example, exclusionary screening has historically been prominent in Europe, while ESG integration, thematic investing, and positive screening have gained significant traction in North America. These diverse approaches allow investors to align sustainability objectives with specific investment philosophies and portfolio goals. ESG investing encompasses a broad range of investor types, each with distinct motivations and implementation methods. Institutional investors, including pension funds, insurance companies, sovereign wealth funds, foundations, and endowments, represent some of the largest participants in sustainable investing markets. These organizations often have long investment horizons and therefore place significant emphasis on sustainability-related risks and opportunities. Asset managers increasingly offer ESG-focused investment products to meet client demand, while wealth managers and financial advisors incorporate ESG preferences into client portfolios. Retail investors also play a growing role as awareness of sustainability issues increases and ESG investment products become more accessible across global financial markets. Asset owners are particularly influential in shaping ESG investing practices because they establish investment beliefs, mandates, and sustainability objectives that guide capital allocation decisions. Many asset owners require investment managers to demonstrate ESG integration capabilities, stewardship practices, and reporting transparency. In response, asset managers have developed increasingly sophisticated ESG research, analytics, and portfolio management frameworks. Collaborative initiatives, such as the Principles for Responsible Investment, PRI, have further strengthened institutional commitment to responsible investment by providing guidance, best practices, and engagement opportunities. The growing participation of institutional investors has therefore been a major driver of ESG market expansion and the integration of sustainability considerations into mainstream finance. The scope of ESG investing extends across virtually all major asset classes. In public equities, investors evaluate ESG factors such as governance quality, climate exposure, labor practices, and stakeholder relationships to identify risks and opportunities. Equity investors frequently employ screening strategies, ESG integration techniques, and active ownership approaches. Shareholder engagement and proxy voting are particularly important tools within equity markets because investors can directly influence corporate behavior. ESG considerations have become increasingly embedded in equity valuation models and investment research processes as investors seek a more comprehensive understanding of long-term value creation and business resilience. Fixed income investing has also experienced substantial ESG integration. Corporate bond investors assess governance quality, environmental liabilities, social risks, and issuer sustainability practices when evaluating creditworthiness. Sovereign bond investors may examine governance effectiveness, political stability, human capital development, environmental vulnerability, and social indicators. Green bonds, social bonds, and sustainability-linked bonds have emerged as specialized instruments designed to finance projects with measurable environmental or social benefits. Beyond traditional securities, ESG considerations increasingly influence alternative investments, including private equity, infrastructure, real estate, and venture capital, where sustainability factors can significantly affect operational performance, asset values, and long-term investment outcomes. Overall, the size and scope of ESG investing demonstrate its transformation into a major force within global financial markets. ESG investing spans multiple regions, investment strategies, investor categories, and asset classes, reflecting broad recognition of the financial relevance of sustainability factors. The continued growth of responsible investment has been supported by regulatory developments, technological advancements, enhanced data availability, and increasing stakeholder expectations. Although regional differences and implementation challenges remain, ESG investing has become an integral component of modern investment management.